Let's now connect with the management of Thermax. Ashish Bhandari, Managing Director and CEO of Thermax Group, joins us now. Ashish, good morning. Thank you for joining us. Uh, okay, let's look at the numbers here, sir. The strong flow or the strong order book inflow continues. Margins have improved. So the big picture is perhaps heartening for Thermax for the quarter gone by. But my question is that if the order momentum is strong and if margins are picking up, then why have you reported flat revenue growth if I look at the sequential numbers?
Flat revenue growth or flat orders growth? We have shown fairly decent orders growth. If you take a good 1 year backlog in a sense, the immediate quarter, both Q3 and what you would see in Q4, last year we reported significant single one-time big orders. This year, actually, until this quarter, we haven't had anything, a single big order to report per se. Nothing of the order of 900,000 crores. So the order book that you see is made up of lot of smaller orders, especially the 10 to 50 crore range of orders. We have had plenty full, and we see the pipeline continuing to be full of such opportunities.
Broadly tell us that as we speak, how much of your order book is the legacy order book which will get executed over next 2 or 3 quarters, and how much of your existing order book is the new high margin order book?
So actually, there isn't that much of a difference between a legacy order book and a new order book. The improved margins that you see are actually just impact of stable commodity prices, which is the environment that we are in. And previously, when commodity prices were going up, we had a bit of an impact on our overall backlog. Also, our chemicals business, which too was impacted by commodity prices and international freight prices. So there is some amount of stability. So it isn't as much of what was old and new. It is just stability in commodity prices, which is giving us a bit of a runway.
So, what's the outlook then on your overall order book as to where you see it where you see it headed? Your order booking was about 10% lower at about 2,204 crore rupees. What's the outlook? Because you did talk about a lot of those small size orders. So, in light of that, can we assume then that the order booking trajectory will be a little bit tempered for the year?
I think that, yeah, the order book trajectory will be tempered, and I've been saying that for some time. Yeah, we do not have as many large petrochemical orders as we did in the past. FGD and petrochemical, both of these areas which give us some of our biggest projects, we don't have those in our pipeline. The good part is those two sectors are also some of the toughest sectors to execute from a profitability perspective. What we have now are a lot of smaller projects. The backlog is reflective in that sense of what the future will be like as well. We see continued activity in some of the sectors, especially sugar, steel, portions of chemicals, but not as much in FGD and refining. So there's a sector shift. Overall, the number of orders and the quality of orders will continue to be good. We won't have as many big orders, which will reflect in our total order book number for sure.
Right. But tell me, Ashish, what is the domestic versus export order inflow looking like? And does it still stand at that 85-15 kind of ratio?
The international situation is better. I think that 80-20 should move more towards 70-30 long term, given our international subsidiaries are also stable and doing reasonably well right now. Overall, we see good momentum both in India and internationally.
Could you quantify though? What's the international order book like and what's the visibility in the very near term?
See, with our business where one single big order can move numbers here and there, so I would say in general, we're targeting a 70-30, that a 30% international business and a 70% domestic. And I think if I look at a 12-month period, at least our expectation would be we would be somewhere in that ratio. At least that's our projection.
Ashish, there are two or three things which markets and investors track with a magnifying glass: order book, margins, and the visibility in terms of where the orders are coming from. Your margins have gone up by about 90 bips if I do a comparison here. But do you think you have enough and more necessary levers in place that if not in this financial year, hopefully somewhere in FY'25, your margins could go to 10%? Because if your expertise is increasing, if the complexity of your projects are increasing, what is stopping you from going to 10% margins?
Okay, I think this will be a slightly longer answer, and I'll give my best to answer our question. Yes, see, Thermax is essentially three separate companies. We have in the sense, three parts of our business that have got different levers. We have a big projects business, which is negative working capital, very low depreciation, very high return from that perspective. But in that business, the profitability, even if you think of a business that is much bigger, will not be anything greater than 5 to 8%. That's the range it will work in. So for you to come and say, look, can you be 10% profitability? That business will never be 10% profitability, but it'll always be very high cash generating of a very low depreciated base. Yeah, so the return on equity will be extremely high. The second part of our business is our products business. This is where you can come back and say, look, can you be 10% profitability? I definitely think we can be 10% profitability, but this is also a part of the business where with all the new energy moves, we want to be investing. We want to be investing in people. We want to be investing in new engineering capabilities, new products, all of that. So we will be in a period of investment. The third part of our business, where a lot of our cash is going right now, is our solutions business and our green solutions business. This is where we are providing energy as a service. So this is where our solar OpEx business is, our biomass-based services businesses. These are places where we own a plant from anywhere from 10 to 25 years. So in most of these, the initial profitability is low, but the profitability over the life cycle is extremely high. In this business, we target return on equity and equity IRR. We don't look at a single year profitability because these are much longer period projects. So you have to look at Thermax as an amalgamation on all three. As an amalgamated business, I don't see 10% as a reasonable expectation. While we have very high growth expectations, the profitability number on an amalgamated business at 10% is probably unlikely.
Ashish, great to have you today on ET Now. Thanks as always for taking the time out, and you can see on the visuals right across the screen, Prime Minister